Investment. If you've ever wondered how some investors manage to build real wealth while others struggle to even beat inflation, the difference often comes down to timing and perspective. It's not just about buying any stock. It's about buying the right stock before the rest of the world sees its true value. In 2026, there are opportunities shaping up right now that most people aren't even paying attention to. And that's exactly why this matters. Because if you're early, you position yourself not only for growth, but for exponential returns once the crowd finally wakes up. The first thing we have to understand is the power of early positioning. Man, think about companies like Tesla in its early years or Apple before the iPhone exploded. At the time, they weren't the giants they are today. They were overlooked, doubted, and in some cases, even ridiculed. But the investors who recognized their potential before the world caught on were the ones who built life-changing wealth. That same principle applies in 2026. Right now, there are businesses quietly building market share, innovating and solving big problems that most investors are ignoring. That's where you want to be, early, informed, and patient. The second point is spotting hidden value. Man, this is not about chasing hype or the next big headline. Most people lose money because they buy when everyone else is already piling in. Instead, investment. The focus should be on finding companies whose fundamentals, revenue growth, innovation, balance sheet strength are undervalued relative to their potential. In other words, investment, where the stock price does not yet reflect the full story. That might be in emerging technology, renewable energy, healthcare breakthroughs, or even in industries being reshaped by AI. The key is to think long-term and understand that the market rewards patience. But we also need to talk about balance. Growth is exciting, but risk is real. That's why the third point, balancing growth and safety, is so important. It's not about going all in on the riskiest bets. It's about structuring your portfolio so that you have both high growth names that could multiply over time and reliable blue chip companies that provide stability. This way, and even if one stock takes longer to realize its potential, your portfolio as a whole continues to perform. The most successful investors don't gamble, they calculate. Now let's get into what you came here for. The top 5 stocks to buy in 2026 before everyone else notices. While I can't predict the future with absolute certainty, investment. These are the names and sectors where the fundamentals and timing line up perfectly. 1. A leading AI infrastructure company. As artificial intelligence moves from hype to necessity, the businesses powering the infrastructure, semiconductors, data centers, and cloud providers are set to dominate too. A renewable energy giant in transition with governments doubling down on clean energy initiatives, companies producing solar, wind, or battery storage are poised for massive adoption. 3. Investment. A healthcare innovator in biotech, medical technology, and gene therapy are becoming game changers. A company in this space could quietly become the next household name. 4. A fintech disruptor. As digital banking, blockchain, and payment systems grow, the right fintech stock has the potential to completely change how money moves worldwide. 5. A defensive consumer staple with growth potential. This is the balance piece. Investment. A reliable company in food, healthcare essentials, or household products that grows slowly but consistently and cushions your portfolio against downturns. These 5 represent different industries. It makes a good investment, but together they offer a strategy, growth, and protection. The biggest mistake most people make is waiting until everyone else is already talking about a stock. By then, most of the gains are gone. Investment. The opportunity in 2026 isn't about following the crowd. It's about anticipating where the crowd will eventually go and getting there first. So here's the takeaway: focus on positioning early. Look for hidden value, balance your risks, and stay disciplined. If you do, investment. 2026 could be the year you stop just watching markets move and actually build wealth from them. When it comes to building wealth in the stock market, timing often makes the biggest difference. The idea of early positioning isn't about chasing trends or gambling on risky plays. It's about identifying companies with strong fundamentals and massive potential before the broader market fully understands their value. Investment. Think about the investors who bought Amazon back when it was just an online bookstore, or those who picked up shares of Tesla when it was a small, experimental electric car company. At that time, makes a good investment, these weren't obvious winners. In fact, many people doubted them. But those who had the foresight to recognize the potential and the patience to hold saw their investments multiply many times over. That's the power of early positioning. It's not about predicting the future perfectly. It's about seeing what others are too distracted or skeptical to notice. The reason this strategy works so well is because markets are inherently reactive. Most investors only buy once a company has already proven itself. They want the comfort of seeing big earnings, widespread adoption, and endless headlines. But by the time that happens, the majority of gains are already priced into the stock. Early positioning flips that equation. Instead of buying after the story is obvious, investment. You enter when the narrative is still developing, when there's uncertainty, when the stock is under the radar, and when the valuation doesn't yet reflect the true potential. This approach isn't about getting lucky. It's about being strategic. To do this effectively, you need to train yourself to look past the noise and focus on fundamentals. What problems is the company solving? Is it addressing a massive market need? Does it have a competitive advantage that makes it hard for others to copy? Is management strong and forward? And most importantly, are the financials healthy enough to support long-term growth? Investment. These are the questions that separate smart early positioning from blind speculation, because it's not enough to be early. You also need to be right about the long-term direction of the business. Another advantage of early positioning is that it allows you to buy at attractive prices. When a company is still small or overlooked, its stock price is often undervalued compared to where it could be in 5 or 10 years. That means your risk to reward ratio is significantly better. You're not paying inflated prices after the hype has kicked in. You're paying a discount for future potential. That's what creates life-changing returns. But it requires patience. Early positioning is not a quick flip strategy. It's about buying and holding through volatility, trusting the vision of the company, and giving it time to grow into its true value. In 2026, this mindset is more important than ever. We're entering a time where new technologies, renewable energy, healthcare innovation, and financial disruption are rewriting entire industries. The biggest winners will not be the companies everyone is already talking about today. They'll be the ones flying under the radar, building quietly, and preparing to dominate tomorrow. If you can spot them early, investment. Position yourself strategically and stay patient. You won't just participate in the market. You'll be ahead of it. That's the real power of early positioning. ChatGPT said, spotting hidden value is one of the most powerful skills an investor can develop because it separates those who buy stocks for hype from those who buy stocks for wealth. The truth is, most of the market operates on surface level information, flashy headlines, trending tickers, or sudden spikes in price. But by the time the majority notices, the opportunity has already shrunk. Hidden value exists where the numbers, the potential, and the long-term story don't match the current stock price. That disconnect between what a company is truly worth and what the market is pricing it at is where wealth is created. The challenge is having the patience and the perspective to see beyond the obvious. To understand this, think of how the market reacts to short-term noise. A company might release a quarterly report that shows slower than expected growth, and its stock could drop 15% overnight. Many investors panic, and assuming that a single bad quarter means the business has lost its long-term potential. But a disciplined investor looks deeper. Are sales still trending upward year over year? Is the business still innovating? Investment. Does it have loyal customers and a strong market share? If the answers are yes, then that temporary dip could be a buying opportunity. What most people see as weakness, the prepared investor sees as hidden value. Investment. Spotting hidden value also means paying attention to industries that are out of favor. For example, renewable energy companies often go through cycles where they're ignored or dismissed because oil prices temporarily fall or governments change policies. Yet the long-term direction is clear. Clean energy adoption is rising worldwide. During the periods when Wall Street isn't paying attention, these stocks can be undervalued gems. The same goes for healthcare innovations, artificial intelligence, investment, or fintech, sectors that face skepticism until suddenly the world realizes how much they're reshaping daily life. Being early in these areas isn't about guessing. It's about recognizing that trends with structural long-term drivers rarely disappear just because of short-term setbacks. Another way to uncover hidden value is by analyzing balance sheets and growth potential rather than just price movements. A company may look boring because its stock isn't making headlines, but if it has low debt, strong cash flow, and consistent growth in a sector poised for disruption, it could be a sleeping giant. Many of the greatest investments in history were not glamorous at the time they were made. They were steady, well-run businesses that simply weren't getting the attention they deserved. By the time the crowd noticed, those who spotted the value early had already locked in years of gains. The real key here is mindset. Instead of asking, what's hot right now? The better question is, what is undervalued today that will be indispensable tomorrow? That shift in perspective allows you to see opportunity where others see risk. And it takes discipline because the market rewards those who think long-term and punishes those who chase quick wins. Spotting hidden value isn't about luck. It's about doing the work, analyzing beyond the surface, and having the patience to wait until the market finally catches up to what you already saw. Balancing growth and safety is one of the most important principles for long-term investing, because the truth is, investment, the stock market, can be both a wealth-building machine and a wealth-destroying trap depending on how you approach it. Many new investors make the mistake of going all in on high growth stocks because the potential upside looks incredible. They see stories of early investors in companies like Tesla or Nvidia making millions and believe that the only way to win is to chase the riskiest, fastest growing opportunities. On the other end of the spectrum, some investors are so afraid of risk that they stick only to safe, slow-moving blue chip companies and miss out on significant growth. The smart approach isn't to pick one side or the other, but to balance both growth and safety within your portfolio so you can capture upside while protecting yourself from volatility. Growth stocks are the exciting part of investing. These are companies innovating in industries like artificial intelligence, renewable energy, biotech, or fintech. Businesses that have the potential to double, triple, or even multiply 10 times in value over the long run. The attraction here is obvious. If you find the right growth stock early, it can change your financial life. But the downside is just as real. Investment growth companies often face uncertainty, high competition, or heavy spending before they become profitable. Their stock prices can swing wildly, and if you invest everything into them, you expose yourself to massive risk. That's where safety comes in. Safe stocks, often called blue chip or defensive stocks, are companies that provide stability, consistent dividends, and steady performance even in difficult economic times. These are the household names that sell products or services people need no matter what the economy looks like. Consumer staples, healthcare giants, or utilities. They may not grow at lightning speed, but they protect your portfolio from big losses when markets turn volatile. Think of them as the foundation of your investment strategy. They might not make you rich quickly, but they give you the peace of mind to stay invested long enough for your growth stocks to play out. The balance between these two depends on your risk tolerance and time horizon. A good investment. If you're young and have decades before you need the money, you might lean more heavily into growth because you can afford to ride out volatility. If you're closer to retirement or want stability, you may allocate more into safety. But regardless of your age or situation, having a mix of both is crucial. This balance allows your portfolio to benefit from the explosive upside of growth while being cushioned by the stability of safer investments. A good investment. It's also important to recognize that balance doesn't mean splitting evenly. It's about creating a strategy that lets you sleep at night while still giving you exposure to long-term wealth creation. Maybe that means 70% in safety and 30% in growth, or the opposite depending on your goals. The point is, a balanced approach prevents emotional decision-making. When markets crash, your safe stocks protect you from panic. When markets surge, your growth stocks make sure you don't miss out. That's how you stay in the game long enough to win. When it comes to building a portfolio for 2026, the real question on every investor's mind is, which stocks deserve a place before the crowd piles in? Investment, the answer isn't about chasing whatever's trending today. It's about looking at the fundamental shifts happening in the world and identifying the company's position to benefit most. That's why narrowing down to 5 categories of stocks creates both clarity and focus. Each of these represents not just a company, but an entire trend with long-term staying power. By positioning early, investment, you give yourself a front row seat to industries that are about to see explosive growth. The first area is artificial intelligence infrastructure. While AI headlines have dominated, the real winners are the companies providing the tools, chips, and cloud capacity to power this technology. These businesses are the backbone of the AI revolution. Investment. They're not relying on speculation or hype. They're selling the picks and shovels in a gold rush. As AI becomes integrated into healthcare, finance, education, and consumer apps, demand for their services will only climb. Investors who buy into this space before adoption becomes universal will benefit from years of exponential growth. Second is renewable energy investment. Governments worldwide are pushing aggressive climate policies, and corporations are under pressure to cut emissions. That creates a massive demand for solar, wind, and especially energy storage solutions. While the sector has cycles of being overlooked, the long-term trajectory is clear. The companies scaling clean energy infrastructure now are laying the foundation for the next decade. By 2026, those positioned in this space won't just be part of an environmental movement. They'll be at the center of a trillion-dollar transformation in global energy. Third is healthcare innovation, especially biotech. Advances in gene therapy, personalized medicine, and medical technology are creating breakthroughs that once sounded like science fiction. These companies are tackling everything from rare diseases to cancer treatments, often with life-saving results. While the market sometimes ignores them because of the time and cost involved in trials, the upside is undeniable. One successful drug or treatment can catapult a company from obscurity to market leadership. In 2026, healthcare innovators represent not just financial potential, but real-world impact. Fourth is fintech disruption. The way people handle money is changing fast, from digital wallets and payment apps to blockchain-based solutions. Traditional banking is being challenged at its core. Companies that make transactions faster, cheaper, investment, and more secure are winning customers by the millions, especially younger generations who expect financial services to be as simple as using a smartphone. By getting in before these companies dominate globally, you're essentially buying into the future of money itself. Finally, the fifth category is a defensive consumer staple with growth potential. This may not sound exciting compared to biotech or AI, but it's critical. These are companies providing essentials, food, healthcare products, household items that people buy regardless of the economy. They balance out the volatility of riskier picks while still offering steady growth. In downturns, they protect your capital. In upturns, they continue to climb slowly. Having this anchor in your portfolio allows you to hold on to the high growth names long enough to realize their potential. Put together, these 5 areas represent a balanced approach: high growth industries where the upside is massive, paired with stability to keep your portfolio safe. The crowd will eventually discover them, but by then most of the gains will be gone. The smart move is to act before everyone else notices, and 2026 offers that window of opportunity.